Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 29th of January, and we have Brent crude oil trading a little bit unchanged this morning in Asia at 77.44. A lot of noise in the world, but not it having, it would appear, a lot of impact on the oil markets at the moment. Let's kick off this morning with Salah Yilmaz, Senior Energy Equity Analyst at Bloomberg Intelligence. Salah, I mean, amongst the bigger questions this month with this new Trump administration has been whether or not his incentives to attract American oil producers to drill more oil and more gas. Your thoughts on the success of that, and will that have any bearing on the markets in the immediate short term?
Sure. Thanks, Sean, and good morning to everyone. Clearly, as you said, oil prices have been steady, but the incoming Trump administration is adding another layer of uncertainty to the market, and I think there's a bit of a confusion in the market, and we're trying to put the pieces together on what this new Trump administration might mean for oil prices. But the way that we've laid it out in terms of the potential upside catalysts versus downside catalysts is that on the upside, of course, there's the sanctions that could result in supply disruption, and it could be significant when you combine both sanctions on Russia and Iran. Tariffs on Canada appears to be seen as an upside catalyst and seems to be a significant one. The potential refilling of the strategic reserves is an upside catalyst, and potentially heightening of geopolitical risks. But on the downside, and I believe that the Trump administration will be a net negative, net bearish for prices in the longer term, beyond this very near term, is because ultimately he has a preference for cheaper gasoline. He wants relatively oil prices at the pump in the US. So that I think is the major downside catalyst that will be the dominant one. But also beyond the tariffs on Canada, wider tariffs and trade wars that we may see with the new Trump administration could be bearish for prices, and a stronger dollar, which is what we're seeing as part of this Trump trade in the market that we've seen. A lot of inflationary policies, which might mean higher rates for longer. Stronger dollar generally could be bearish for oil prices. And to your point, higher US production. We actually don't believe that this is going to be one of the big downside catalysts. I mean, we don't really think that administration and who is in White House makes a huge difference. I mean, you could argue that the Biden administration wasn't as pro-fossil fuels. That is one of the arguments, but then US oil production was at record high levels. So looking beyond now with the new administration, yes, I mean, there might be some push for oil producers to spend more and increase their oil production, but it will not be, there will not be a massive difference. And one thing to note also is that even if they were spending a lot more, the marginal growth in the US production would probably be geared more towards natural gas and natural gas liquids rather than crude oil. So marginal growth for crude there would be limited as well. But when you combine all of that, a lot of moving parts in different directions. That's why I think the market is a little bit confused. That's why we see this uncertainty in the market. But net, ultimately, Trump's preference for relatively oil prices at the pump, I think, will influence his decision making and perhaps sanctions enforcement, and perhaps his tone against OPEC Plus to make sure. Yeah.
There's certainly no long list, no shortage of things to add to the and list. Bora Bariman, managing partner at Hormuz Straits Partnership. The question ultimately is, will the banks fund greater oil production capacity expansion, particularly in the US? I mean, they have to spend a lot of money just to maintain production because, as we know, in the shale production, wells deplete quite quickly. Do you expect Wall Street and the money men to provide the capital required to advance, to actually add capacity above, not just maintain?
I do. I think that, the signals have been sent that the net zero partnership, Green Alliance memberships have been canceled, and Wall Street and corporate America have essentially kind of bought on to the so-called reindustrialization vision that Trump has outlined. Of course, there will be scrutiny, as you would normally expect, on the cash flow outlook, and the competitiveness of each borrower that is requesting a loan package. But I don't think there will be sort of the ideological sort of gate that had come down on upstream finance that we had experienced, I would say, between certainly from 2016 through this year.
I suppose very simply on the outlook for return, the idea that $70 US oil, is that enough to spend a lot of money in the ground? That remains, I think, a question. Never mind all of the politics and the energy transition. Let's welcome to the table this morning a new voice, Mohammed El-Jar, co-founder of Libya Outlook for Research and Consulting. I suppose it does what it says on the tin, Libya Outlook for Research and Consulting. Welcome, Mohammed. Perhaps as a starting point, you can give us your outlook for oil production in Libya for 2025, where we're at, where we are likely to go to.
Yeah. Thank you very much, Sean. Happy to join you for this daily podcast. And Libya has been doing quite well in terms of increasing production. So as we speak, Libya is producing just over 1.4 million barrels per day. And that is the highest number of production that Libya has reached since 2012. And the country is slowly on course to reach 1.6, which is the pre-2011 or the pre-fall of Gaddafi regime, hopefully by the end of, by 2026. And some ambitious estimates put it that this year we might see that. However, the problem that you would have with Libya is the instability that Libya is, what comes with a failed state, with foreign interference in the country. And just yesterday, we saw the news coming out from Libya that exports or loading from the oil crescent region in Sidra and Ras Lanuf was stopped by protesters making certain demands from the National Oil Corporation. The exports were stopped for a few hours, resumed, but there is an ultimatum of 2 weeks. And that is the kind of environment that you have in Libya, despite the huge potential that the country has. And this year, Libya is supposed to have a new round of licensing and concessions. Actually, they have like between 15 and 21 exploration blocks across 3 basins in Libya. But then it's a question of, if the environment is not stable enough, will foreign investors be interested, or foreign companies be interested in coming to a market that's like Libya? Obviously, geographically speaking, it's quite well positioned, and the costs of exploration or exports are lower. But then you have the political institutional risk, and then the risk of conflict that continues to linger in Libya. In addition to that, obviously, Libya also has a huge natural gas potential, but unfortunately, even the current capacities for exports through the Green Stream to Italy so the capacity is like 11 PCM per year, but only 2.4 PCM per year is being exported through the Green Stream to Europe through Italy. So you can see where there is a huge potential, but also at the same time, you have all of these risk factors that have made Libya an unattractive, if you like, destination for foreign companies and investors, etc.
Salah, looking at some of the geopolitics backdrop, the hangovers from 2024, obviously the Middle East, the regional conflicts seem to be on a pause at the moment. There's ceasefires, as fragile as they are in place currently, and we have the Houthis stepping back from disrupting the Red Sea, and it would appear that maybe flow returns to normal there. What do you think that outlook has for the regional industry, for regional energy flows, for the appetite for risk?
Yeah, I mean, we were arguing through last year that even though geopolitical risks were at heightened levels, we didn't actually have much impact on oil flows. So we argued that the geopolitical risk premium that was attached to prices was actually negligible even last year. So, I mean, the temporary ceasefire is great news for the region, but it doesn't really have too much impact on oil prices, we think. And when we say geopolitics, we are a lot more focused on the impact of potential sanctions. Again, not only on the prospect of more sanctions on Iran, which is what I think a lot of market participants were focused on with the incoming Trump administration, but now that we have these increased sanctions on Russia that were brought by the outgoing Biden administration, we think these were actually the toughest and the most aggressive sanctions on Russia. I mean, we are yet to see what the actual impact might be, given how resilient Russian oil flows have been. It's, I think, fair to assume that the actual impact will be less than initially assumed. But in terms of geopolitics, that is what we're focusing on a lot more than the Middle East at the moment.
My question really is more pointing towards the appetite in the region, the idea that we saw, for example, Saudi Aramco back away from its plan last year to add an extra 1 million barrels a day of production capacity. We have Kuwait now looking to add. Obviously, the UAE continues to be on a spend and expansion program. Does this sort of settling down of the geopolitical sort of backdrop give greater incentive or have any impact on those momentums of the regional spend, the regional confidence production?
I don't think so. I think the demand is a much bigger and more important factor there than what's been going on geopolitically, especially when we talk about Aramco's plans that have been halted. I think they would really need to see demand growth come back and be strong, and they need to see more room for that marginal expansion for there. I mean, currently they're sitting on so much spare capacity that I think it made a lot of sense for them to delay those plans. I mean, in the next few years, if really demand grows more than where we see it at the moment, and perhaps the supply growth outside of the group surprises to the downside, and suddenly we see a little bit more room for OPEC Plus and for Saudi Arabia and for Kuwait, perhaps, to actually supply more crude to the market, only then I think these plans could come back. So I would be watching demand a lot more closely than the geopolitical developments in those cases.
Bora, this is a week in which we have the Fed due to meet again and to decide on the direction of their rates campaign. It's generally viewed as an easing cycle. Do the oil markets currently care about where the Fed is? Should they care? What's your expectation for the Fed this week, and where do you think it intersects looking forward for the energy markets?
Yes, I think the global energy market is quite deep and obviously wide. I'm not sure the Fed affects them so much, but it goes back to your question about availability of capital. I do see that the easing cycle will be a theme, because there will also be political pressure, loud political pressure from the administration to continue with the easing cycle and direct the capital to investment grade borrowers, which are the the players that own the commanding heights, the Exxons, the Chevrons, the P66s. I think they are the ones that was referring to, that would have access to the capital to unlock more upstream resources in North America, and they will be protected, in my anticipation, by tariff walls from, especially with respect to Canadian product. So there will be a certain case for investment into the sector that incrementally will be higher, clearly, than what we experienced in the Biden administration. There will be more investment going into the sector.
But where do you put the intersection, Bora? I mean, we have the general Trump narrative around tariffs and the sort of conflict of that. Of course, that's generally inflationary. We already have the CPI stuck above 3% and really not coming down. How can this be an easing cycle under those backdrops and full employment?
Right, we make trade-offs, right? And I think the trade-off, I've made this sort of jest comment that we live in an Erdoganian world. So I think the trade-off will be growth and managing the debt mountain out there at the expense of higher prices. One, tariffs are inflationary. You're right. But what will even European and other countries that need access to the European market, to the American market, need to do in response to the tariffs? They'll need to devalue their currencies. So it's sort of a race to the bottom that creates an inflation all around that will percolate throughout the system, in my opinion.
The situation, Mohammed, in Libya, geopolitically, we've sort of talk a lot about the region where the great fractures have been in the last year, around Lebanon, around Palestine, and the Red Sea, and so forth, and sort of not so often about Libya. And obviously, we've had Syria regime fall in recent weeks. Where is Libya caught at this time in the sort of geopolitics of the region? Is Russia getting a grip on the country there? Does Russia look to Libya now as a new sort of anchor in the Mediterranean out of Syria? Your thoughts on where Libya goes forward geopolitically?
Yes, absolutely. So the events in Syria have two types of impacts on Libya. So there is one that is more immediate, in my view, and it impacts directly the conflict dynamics in Libya, be it on the local level or be it on the level of the foreign actors that are intervening in Libya. And this has two parts to it. The first one is, given that Turkey is hugely involved in Syria, played a key role with its proxies in the fall of the Assad regime. And immediately there has been reports and talks that the Turkish government is trying to sign a delimitation or demarcation agreement, if you like, with the new Syrian government. And then that completes a little bit its strategy for the Mediterranean, where they have also a deal signed with Libya there. And then also there is this concern that maybe we will, at least concern in Benghazi, where I am, that Turkey might try to replicate that strategy that they had in Syria in Libya. as well. Although I think obviously there are key differences there, and I don't think that's a likely scenario as things stand. And then the other side of it is Russia. Obviously, we have seen all of these reports that are talking about Russia moving assets to Libya, increasing its activities there. And the fact that obviously Russian presence is in the Libyan desert and in the central region, and these are key areas for oil and gas production in Libya. But I wrote an article earlier this month where I said things are not as straightforward for Russia in Libya as they were with the Assad regime, because Russia has been trying to sign a deal with the eastern-based authorities in Benghazi, with Khalifa Haftar and the House of Representatives in Tobruk, that have so far failed. They have been trying since 2020 to sign such a formal framework in Libya, but those actors on the ground have been resisting those, if you like, this pressure or those calls by the Russian side. But I think from an energy perspective, there is the element of Turkey, I think, which is a dominant one, which I think if they continue to basically dominate the scene in Syria, and they successfully manage the transition to a somewhat stable governance there, and then you complete that with them getting agreement from Khalifa Haftar and the Eastern authorities to recognize the demarcation, delimitation agreement that was signed in 2019, then that puts in question again, the Eastern Mediterranean becomes yet another trigger, if you like, for some sort of a standoff with the Europeans, with Cyprus. And
where you haven't mentioned the infamous Donald Trump or the US at all in your analysis. Where does Libya intersect these days with the US administration? Obviously, Biden gone, now the new Trump one.
Yeah. Absolutely. So I just published an article specifically on that question. Unfortunately, I don't think Libya will be high on the agenda for Trump. However, given the importance of the country and the involvement of key regional actors in the conflict, of course, it will be a topic for discussion. And I think the two main files that Trump will focus on Libya over the next 4 years will be the energy question, and it's just for a matter of like trying to stabilize, if you like, global energy markets and just ensuring that Libya does not impact that with the kind of instability that we have in the country, i.e. no shutdown of oil production. And then the other, or maybe even opportunities, but again, opportunities for American companies to get concessions. And by the way, the outgoing or the former NOC chairman, Farhat Benabdara, who left his post this month, has actually been in dialogue with major US companies to actually take part in the new licensing round. And I think there has been some progress there where American companies might get favorable terms as opposed to others. But we don't know how that will change with the change in leadership and with the internal dynamics that exist in Libya, especially that we have UAE, Turkey as the newcomers that are trying to dominate Libya's energy market. And then the other file that I think Trump will try and focus on is the question of normalization and the expansion of the Abraham Accords to include Libya. I guess that will be a target, that will be an attractive target for Trump. But again, given the instability that exists in the country, the lack of an authority that's able to govern and enforce any such agreement if they ever come. And I argue in the article that I published that they need to look back to their experience with Sudan in October of 2020, when they tried to force Sudan to have normalization, or to force the weak transitional government to have normalization, which then faltered, failed, and didn't work out. So if Trump is going to go in that direction, he will need to do, and his team will need to do some groundwork to ensure that there is an authority that's able to govern, an authority that's able to enforce any such agreement or expansion of the Abraham Accord.
Let's go to the survey question and just sort of get a quick reaction from all of you on that. What will have the biggest impact on oil prices in Q1? Trump 2.0, and as Yilmaz suggested earlier that the market's still trying to digest. Every day you wake up, there's another long list of issues to deal with, and February 1st now apparently is going to include sanctions on Canada and Mexico, if indeed, or not sanctions, but tariffs. China's stimulus continues to be there in the backdrop. They started that in the Q4 expectations. That continues to revive the Chinese demand center. Of course, still the anchor of global incremental demand growth for the last 30 years. Will it continue? Does it continue to be a direct bearing on oil markets in the short outlook of the first quarter? Or geopolitics, as mentioned there a little bit by Mohammed, could Libya even be brought into the Abraham Accords? Does this ceasefire that is being extended in Lebanon just for 10 days, and of course the fragility of Gaza, we saw 300,000 people move from the south of Gaza to the north of Gaza over the last 2 days to find their houses are destroyed. Netanyahu's on his way to Washington. Where is the geopolitical stresses in the neighborhood? What will have the biggest impact on oil prices in Q1? Your view on that? All of the above, of course, is not an option, but you'd probably press it if it was. Welcome everybody's sort of review on that as you go around. Sally, your thoughts on that in the immediate outlook? If it's not those three, is there something else that could have a bigger impact on oil prices, oil markets?
Yeah, I mean, I shared my thoughts in great detail earlier, so I'll try to be very brief. But I voted Trump 2.0. I think that's going to be, at least in the very near term, that's going to be the most important one. Of course, China is the big story on the demand side. But with these Chinese stimulus, it used to be that the moment they announce one, there would be a big oil price reaction. It seems that in the last couple of times they did it, the market seems to be really waiting to see how well these stimulus packages would be executed rather than just reacting on the announcement. Definitely something to watch on the demand side. And again, very briefly on geopolitics, even last year when we had geopolitical risk at very high levels, we didn't think that actually had a big impact on oil prices. So I would think that would be, out of these three, that would be the least important.
Bora, your thoughts?
Look, I don't think China is a factor because they are making the energy transition, and it's America that has sort of thrown that out. So I think obviously Trump will be more influential. What effect
But China
that will
could
be, I think,
surprise on the upside a bit. We start the year and sort of contrast opposite to last year. Last year, January, everybody was like, China is going to save the world in terms of oil demand growth. This year, we're starting with the exact opposite kind of posture. Generally, very little expectation from China.
Yeah, I think China sticks to their plan. And they want to make the energy transition, right? And they've got the AI, they've got the batteries, they've got the grid investments. They will have demand for those materials, the copper, the nickel, the lithium, and certainly their industries will require energy, but it won't be as oil intensive as it was. Look, I think we can see very clearly that Trump's vision, I think, will be implemented with variations to be negotiated. The plan is they ratchet up tariffs up to a possible 20% across the board, unless they're waived through bilateral negotiation by the parties, the other country agreeing to transfer a lot of money to America, whether that's through procuring U.S. weapons, buying American
Good
oil.
old-fashioned buy your protection.
Or exactly. And so I think the winners of this era will be, number one, the U.S., who is the master of its own destiny, and the BRICS countries, because they have been planning for a non-dollar centric order. And the countries that need to struggle a bit are those that look to the U.S. for leadership, economic support, security umbrella. They'll have to pay a hefty premium for that.
I.e., where you're sitting, the UK and Europe, the weakest link gets the biggest punch in the Trump universe. Mohammed, your thoughts on the outlook for the immediate term in terms of the biggest impact for oil markets, Trump 2.0, China stimulus, geopolitics?
So I put Trump 2.0, and the reason for that is because Trump is likely to have a huge impact on the geopolitics question as well. And given that Trump is going to go isolationist, very transactional, I think that will impact the behavior of certain actors in the region. And one example is Libya. It was under Trump that both Turkey and Russia developed a military footprint, and they became actual actors in Libya and in the Mediterranean. And the question is, if Trump is not going to pay attention to that file again, will Erdogan get adventurous in Libya again? You have also the question of Sudan, and will Russia get a little bit more adventurous also in Africa? So all of these are, I think, question marks that we have. But the example of Libya under the first Trump term indicates that certain regional actors will also become more transactional, more adventurous, and they will also try to look for their own interests, and they will think that Trump's way of viewing the world or worldview is going to enable them to do that, and that can be risky in conflict theaters such as Libya or the Mediterranean.
Well, I concur with the view of the sort of Trump 2.0, but I as being the biggest impact in the immediate and perhaps even throughout the year. But my thoughts are the most immediate impact of Trump is not the Trump punch, but it's actually the counter punch. What will the counter punches look like to Trump's actions? Will Canada and Mexico take 25% tariffs on the chin, or will they punch back? And what will that punch look like? We're seeing the punchbacks. We saw a little bit from Colombia last week. Earlier this week, it had a brief moment in the sun. But was the China announcement of this magic new AI tool the day after the $500 billion show in America AI rollout, was that coincidence or was that a punchback? So I think the big issue for me is not the punch from Trump, which is expected and very common and obvious, but what's the punchback going to look like? That's going to have a big bearing on the direction of travel. Thank you, Bora Bariman. Awesome as usual. Salih Yilmaz, my fellow Dubaian. And of course, lovely Mohammed Elijah, to have you join us on the podcast, and we'd welcome you back soon again. All the best, everybody.
Many thanks. All the best.